Our mentor and quant trader Christopher came up with this insane educational text that I want to read to you and go through with you in this video. I must been reading it like, 15, 20 times. It's actually not very hard to understand, but it's just so good that you want inhale it and make it your Bible if you are a trader. And as always, this content is completely free for you. And if you find this content valuable and you want us to continue, please hit the like and subscribe. Activate the bell, because this really keeps us motivated to make more of these videos. So have you subscribed already? That's good. See you after the intro. Trading is a game of doing what's necessary to be profitable. Amazing. What does it mean? Unfortunately, this includes taking losses. The rate of loss taking that is necessary is in opposition to what a typical human brain can take before the release of the emotional response that makes trading impossible for most. So this is just in one sentence describing everything you need to know why most people fail on the stock market and trading. So hard to take losses. People rather accept a huge drawdown when they do investing or dollar cost averaging. They have a 40-50% drawdown. But when a position is being sold in a tight stop loss and you just lose $20, $50, $100, it feels horrible, especially if it's like 10, 15 losses in a row. So people tend to let their losers ride instead of, let your winners ride, is what you usually say. People do the opposite actually. So the answer is to systematize the taking of losses, whether that be by the manual application of a framework or to fully automate the process, like we do it with Tyson, like we do it with 3Commerce, and so forth. I love the next one. Ultimately, trading successfully is a game of systematic loss taking. Most traders are trying to maintain a high win rate, and this is no more than a defensive behavioral response to the risk they are taking, which creates the very outcomes they are trying to avoid. Let me read that again. Most traders trying to maintain a high win rate, and this is no more than a defensive behavioral response. So you don't want to feel these bad emotions when you see your stop losses being hit. And your defensive reaction is letting the losers ride, or only trading strategies with a very high win rate, which of course have much bigger losers than strategies with a small win rate. Okay, the sentence goes on with to the risk they are taking, which creates the very outcomes they're trying to avoid. Yeah, we talked about that actually. The reality is there is a correlation between low returns and high success rate measured by individual trades. So statistically, it means when you have a high win rate, you have low profits. Sounds kind of counterintuitive, right? With the highest return strategies over time, the expected percentage of profitable trades should be around 20%. Just 20% win rate. You see all these people on YouTube claiming 95, 99, 100% win rate. These strategies do exist, but then you have a left skewed distribution, it's called. Your median is like here, you got all these winners, and then you got a huge loser that will take out all of your gains that you had for 1 year or more, with the remaining 80% being stopped out for small losses as quickly as possible to free up capital for the next successful trade. Makes sense. Taking an approach in this way is extremely hard for humans to apply. It goes completely against our nature of avoiding bad emotions, avoiding situations we feel bad in, of course. This makes sense. But this doesn't make sense for the stock market. It makes sense for social life, and especially in earlier years, being in the nature, surviving there, which is in complete opposition of how trading works. Furthermore, many of the trades that are stopped out continue in the desired direction, which creates even more frustration for the trader. We have all been there. Here lies another reason in that what is necessary to be profitable is close to impossible for the typical human to accept. 95-98% of the traders fail. You have to be superhuman or you have to systematize your trading. All of these reasons push a fear of regret and ultimately have the trader to make the easier decision to buy and hold and accept a suboptimal method that is not in control of the trader, but at the mercy of broader market gyrations. I think this is just another summary of what we heard before. I think the point is clear. Please let me know down in the comments what you think about this text. Share this video with your friends, with your fellow traders, and I hope to see you in the next one.